Welcome, everyone, to week 2 of financial management for nonprofit organizations. So this week, we're going to review the basic accounting terminology, the language of accounting that you're going to encounter and you'll be using in financial management. And we're going to review the formats and how to use the 3 most basic reports you will encounter, which are the Statement of Financial Activities, the Statement of Financial Position, and the Statement of Functional Expenses. So let's take a look at some basic accounting terms, the vocabulary of a new language. Assets and liabilities are 2 words, and they're concepts that you will see the most in financial management. Assets, very simply, are what you have. They're good. And liabilities are what you owe. They're painful. So assets are what you have, and interestingly, also what is owed to you, what you expect to receive, and it includes all things of value, such as the cash, the revenue that is owed to you, and also any inventory you have, property, etc. So there's several ways to look at assets, and we're going to look at one of them now. We'll look at others later in the course, and that is the concept of current assets and fixed assets. So a current asset could be cash or could be turned into cash within 1 year. It's as simple as that. It's what's in the checkbook after you have reconciled all your bills. It's what's in your savings accounts or temporary cash investments like CDs. And it's the money that is owed to you that you expect to be paid within the year. And those are grants receivables, pledges receivables, and if you have prepaid some of your expenses, say a year's subscription to a periodical, that is considered a current asset. Now, fixed assets are generally things you could touch. They are tangible, and most typically they are buildings and property. Now, the difference between these is important because current assets could easily be used to pay your bills, while fixed assets would be involving things like selling property would be a very lengthy and complicated process. So, liabilities now. They are what you owe. And that includes bills, mortgages, accounts payable, your payroll, your loans, etc. And again, it's divided into both current and fixed. Current liabilities, again, it's what you owe or will owe within the year. And that includes all the accounts payable. It includes a year's worth of payroll, any bills that you are expected to pay within the year. While long-term liabilities are, as it sounds like, long-term, you are expected to pay them off for longer than 1 year, and mortgages are a very common example of a long-term liability. Then the next concept you will be familiar with is net asset. Very simple piece of algebra. A net asset is your total assets minus your total liabilities. Revenue versus cash. Revenue is payment for services, whether it's a membership, a program, a government contract, etc. Your grants, donations are revenue, whether they have arrived or they've been promised to you, while cash is literally what's in the bank or in your hand. To recognize means to enter, to record it into your financial records. A check, a revenue that you have not entered has not been recognized. And in another week, we're going to talk about the timing of recognizing both revenue and expenses, because that, in fact, there are several varieties of ways in which both assets and liabilities can be recognized, and it makes a big difference. There is a Financial Standards Accounting Board, which has in fact standardized what reports a healthy nonprofit should be generating regularly. And it defined what a complete set of financial statements should include. There's a statement of financial position, statement of financial activities, statement of cash flow, accompanying notes, and a statement of functional expenses, and we will look at that in the next video.